welcome back. This is our Q1 2026 Perspectives. I'm joined by our CIO, Doug Walters. Hi, Doug.
Hi, Jay. Nice to be here.
Yeah, and so we're going to recap our 2026 Q1 Perspectives, which you can read on our website. Doug does a great blog version of this as well, and we're just going to be touching on that as well as some other topics today.
Yeah, looking forward to it.
All right. So, Doug, our first question to open it up is a fun one. If you had to describe Q1 2026 in one word, what would it be and why?
This might sound strange coming from me, but I would say emotional.
Mm-hmm.
There was a lot going on between AI and the conflict in Iran, just a lot to deal with as an investor. So I think emotional kind of sums it up.
Yeah. And with all that, right, we're talking about AI, geopolitical tensions. Why did the quarter feel more chaotic than it actually was?
Yeah, it's interesting. We started the quarter with AI, right? We knew, that was one of the key talking points going into the quarter, and it proved to be really influential on returns throughout the quarter. So we had segments of the market that really suffered in the wake of AI, primarily software, professional services, these areas where investors are sort of getting the sense that AI can take over some of the role of these industries. And so we saw big disruption there. Some of these sectors down 20+%. And then you throw on top of that a major conflict in Iran, throwing oil prices up sky high and putting a lot of uncertainty out there. There were a lot of scary headlines and a lot of, I would say, negative and emotional sentiment. And when we got to the end of the quarter and looked back, it really wasn't that bad as an investor.
So why is that? What's the disparity between headlines and the actual experience investors face in their portfolio?
Right. I think, at least for us, part of it is diversification. So the S&P 500 was down around 4%, which isn't, really anything terribly unusual.
Mm-hmm.
But it doesn't feel good when the market's down. But small cap was up, mid cap was up, international was flat, bonds were flat, gold was up 8%. Mm-hmm. So there are other parts of the portfolio that were making up for the negative returns that were coming in U.S. large cap, which is where a lot of the headlines were.
Yeah, and I think that makes sense. So I want to kind of dive into some of these topics. So specifically with the Iran conflict, gas prices rising in relation to that, how does that indirectly impact everyday investors through inflation and other items like that?
Right. I think the way I would like to, I guess, answer this question and think about inflation is it's a big risk with inflation, especially when it comes around scary headlines like a major conflict, is that people could pull their money out of the market, put it in cash, put it in some other low-yielding vehicle, but inflation is increasing the cost of everything. So if you're earning nothing on your cash or very little, you're not keeping up with inflation. So I think how it can impact investors is it can reduce their purchasing power or the value of their assets in real terms if they don't keep it invested. So we always are touting, stay invested at an appropriate level of risk for you. Never play this game where you're throwing a large portion of your assets into cash. And inflation is a big reason why you would never want to do that.
Mm-hmm. Yeah, and so, with the Fed already cutting rates, why does the uncertainty still feel high?
The uncertainty with rates, inflation, yeah. The Fed controls one little piece of the yield curve, right? They control the short-term rates, and what we saw in this quarter is that the rest of the yield curve went up, meaning yields went up. And what does that mean for you and I and for everyone else out there? the cost of a mortgage went up, the cost to finance a car went up. So the Fed can control a portion of that curve, and they can tend to, if they lower rates, they can kind of drag everything down with it. But there are other impacts on the curve. We saw them this quarter. Rising tensions, rising uncertainty will raise the risk of those investments, of longer term investments. And so yields go up. We pay more for loans.
Okay. Yeah. So switching over to talking about AI a little bit, the one question that I wanted to ask, and I know it's going to be tough to answer, but are we watching a repeat of the .com era, or is this something entirely different?
Yeah, I think ultimately time will tell. And my guess is one place I will say we are likely to see a very strong parallel is that if you live through the .com bubble, the ultimate winners were not known in the moment, right? The ultimate winners were found out 5-10 years later. It took a while for that story to play out. And those early winners, the literal .coms, pets.com or what, they didn't survive. And I think we'll see the same thing with AI, is that there's going to be a lot of turnover in the winners and losers. We've already seen it to some degree in the large language models where, it was ChatGPT was dominating everything, and now suddenly Claude comes in from Anthropic and seems to be a better tool now. There's going to be a lot of this turnover, and winning that battle doesn't even necessarily mean you win the battle with investors. You've got to make money. If you're just pouring money into these models and you can't produce cash out of that, then you're not going to do well for investors. So the ultimate winners, we won't know for a long time, and that'll be, I think, the biggest parallel.
Yeah. With AI supposedly having such a tailwind, why are sectors like software getting hit?
Yeah, so big disruption is what investors are seeing in software. The ability to use AI to replace, basically build some of these software tools in a matter of literally minutes, what used to take a year to develop. And I've seen it firsthand, maybe not as robust as something built by a well-staffed software company, but in a matter of minutes, you can create, something to track your to-dos or something like that. And, these are billion-dollar businesses for some companies, and they're seeing their business models upended by the ability for the average Joe to create these tools.
Yeah. Yeah. And I think that's interesting from someone who uses AI a lot. It seems like every day, but every week something different comes and you're like, oh, this can, AI can do this now.
Right.
And I don't know that anyone, we see a lot of these charts of like what jobs are at risk from AI. And, I would, from my standpoint, be cautionary on that as well, because we don't know, because it seems like it's going to change one job, but then you start digging in, you're like, oh, no, that job's fine. But then another one comes out of left field and you're like, oh, okay, we didn't see that coming. So
right.
It's very interesting how it's, evolving over time.
Yeah. And it has the ability to create a lot of jobs as well.
Yeah.
New jobs that never existed before. So there's definitely opportunity and there's disruption. And I think what we saw a lot in this quarter was that, the give and take of that disruption and opportunity.
Yeah. Yeah. And I think really that's a great way to put AI in a nutshell, right? It's both. Yeah. So, and we talked a little bit about diversified portfolios holding up. And I guess the question is, and you may have answered this already, is why are they diversified portfolios holding up so well right now?
So we talked a little bit about the individual asset classes, and I think, so that's a lot of it, right? The fact that gold was up 8%, if you have gold in your diversified portfolio, that's going to give it some buoyancy. Bonds, again, held their value, so they didn't, gain or lose value. And within equities, we saw small cap outperforming. So I think it really is that mix of assets that is allowing investors to, talking about AI, participate in the opportunities, not just the threats.
Yeah.
So a lot of those threats were in, say, to Microsoft, right? And Microsoft was down 25%, a huge component of a U.S. large cap equity. If that was your whole portfolio, it was a bad quarter.
Mm.
But small cap stocks actually outperformed. In fact, small cap tech was up on the year, on the quarter, which seems a little bit odd since we just talked about the ability of AI to disrupt these companies.
Yeah, and I guess when we're thinking about this as a whole, even with diversified portfolios, one of the questions I did want to ask was, why did drawdowns feel like danger when historically they're normal?
Yeah, it's just human nature. We tend to feel pain a lot more than we feel joy. So it's a very commonly understood behavioral bias that we have. Those losses that you feel, a 10% loss feels a lot worse than a 10% gain. So anytime you have a drawback, you're going to feel it more than when the market's going up. What we like to do, and we would ascribe to, is what we call opportunistic rebalancing. We love these moments when the market pulls back, because then we can rebalance, we can sell some things that have held up better, like gold, and then buy these cheaper assets at a lower price. So we love to take advantage of them. You have to have those sort of nerves of steel and understand that this is just a normal part of functioning markets.
And would you say that, we always talk about no one can predict the future. We can't predict what's going to happen. And so is there, between diversified portfolios, rebalancing, knowing that, your team is on it, does that make it okay not knowing what's coming next?
It does. I think, what we talked about in perspective was just focusing on what you can control. You just can't control what's coming next. So you can't worry about it other than to do what you can to prepare for it. And how we prepare is having that diversified portfolio, being ready with the opportunistic rebalancing. When we talk about rebalancing, we're not talking about, every quarter at this time, it's the end of the quarter, let's rebalance portfolios. We're looking every week for these moments when something really steps out of bounds, breaks breaches some corridor of underperformance or outperformance, and then we take advantage of it.
Yeah.
So it gives us peace of mind knowing we don't have to predict the future in order to do well by our clients.
Yeah, I like that. So for the folks out there watching this, if there's one thing they should take away from quarter one of 2026, what would you like that to be?
Boy, if there's one thing, I think it is that to stay away from the headlines.
Yeah.
Right. It'd be so easy to think, with all the headlines we faced in this first quarter, that it was a dreadful quarter for investors. That dread can lead to irrational action, like pulling money out of the market. If you stay away from those headlines, you're more likely to be in it for the long run, stay invested, and reap the benefits of markets that tend to go up over time.
Yeah. All right. Well, thanks, Doug. I really appreciate your time.
Yeah. Thank you.